We got the monthly lunch on.
Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today's webinar. We host our monthly Lunch and Learn at noon on the last Wednesday of each month, and we're so glad that you were able to join us today. Today, Graham's going to start out with a wrap-up of 2022's market conditions, and then he'll provide a 2023 market outlook. He's going to touch on some of the economic concerns from last year and also discuss how things look for this new year. Don't forget, you're going to see Graham's calendar pop up from time to time during our presentation. And if you'd like to schedule some time to talk with him or really anyone on the team, please click on that calendar when it pops up and choose the day and time that works best for you, and we'll get you scheduled. And now let's go ahead and get started with today's webinar. Graham?
Super. Thank you, Stacy. And also thank you to everyone that's on the call and being a part of this call. You know, what a year last year, right? Stacy, I don't know if we're noticing, but I think I'm seeing the PowerPoint not there.
Okay, should be there.
It's coming down.
Okay.
All right. But yeah, you know, we had a really volatile year, and I'm not trying to be flippant about it or understate the magnitude of what happened last year, but you know, it was a very volatile year. It came off back-to-back positive years, off a really positive last decade. If you look at the S&P, you know, on average, we saw the S&P over the last decade somewhere around a 15% average annual return. Over the preceding 3 years, even though we've had a dip at the height of pandemic, it rallied back very strong in a V-shaped recovery, and then we saw the market average somewhere around 20+% average annual return, maybe close to 26. So to have a year like last year is never comfortable. It's never fun to go through, but I don't know if it's not unhealthy. I think it might be quite healthy to kind of flush out the system, bring the over enthusiasm that we saw in that market down a bit, so we can kind of clean the pipes, if you might, to set ourselves up for next bull rally. And that's what we'll chat about today as we wrap up 2022. So first off, let's jump into that before we get up into 2023, which I'm sure everyone wants to hear about, right? Well, let's talk about it. You know, we talked about in 2022, we had that wall of worry. We had to worry about a war that broke out. We had inflation rampant, well over almost 10-odd%. We had the Fed really implement the tightest Fed policy, or maybe the quickest rate hikes ever in history over the last 6 months. We had extremely strong dollar. We saw added weakness in the international currencies, which makes our goods and services less attractive from a currency conversion ratio. We had recession fears rampant. How deep, how protracted was this recession going to be? We still had China shut down, right? We had other economies starting back. We opened back up, but that's a huge multi-million individual economy that consumes a lot of goods and services and produces a lot of goods and services. So that was shut down. And then we went into the ominous inverted yield curve, meaning that longer dated bonds were actually yielding less than short dated bonds. And that's usually the reverse, right? So a lot to be really be ultra fearful of. You know, 3 things that we really highlighted that were probably the most pressing for us was inflation, the Fed's action to bring inflation down with our tightening policy, and how and if that would push us into a recession, light, as we felt all year long would be a light recession if we see any at all, maybe not a deep protracted one. So let's kind of see where we're at. And we didn't fall into a recession last year from a U.S. economy standpoint. Now, have we had certain sectors drift into a recession? Sure. We've have rolling recessions within sectors, say the housing market per se, off of their highs yeah, that would be in a recession, so on and so forth. But no, we did not have a recession. And the downside to the negativity that was pushed upon us in any publication or any news channel you turned on is that they scared the heck out of you. They scared the heck out of you that the world was going to end and we're going to be in a deep protracted recession. And I'm glad to say no, we're not in a deep protracted recession. That didn't happen last year. So what do we hear now? Well, now they're pushing their opinion off that we're going to be into this year. But in 2023, it might have changed a little bit. So let's jump into that. If we think about 2023, we're looking at a war is still active, right? So let's cover what happened in 2022. Is that still going to be a hallmark for 2023? So we still have a war that's going on right now. Hopefully that won't escalate. Hopefully we can get some de-acceleration to that, which I think will add to sentiment in the markets, not to mention supply chain issues, so on and so forth. Inflation, listen, that's coming down. Well, we got close to 10%. I think we're 7.2%. And all the numbers that we're seeing right now, they're coming down even further. So that inflation's coming down, that Fed tightening that has gone on over the previous 6 months, so dramatic, so quick, so fast. We think they're setting themselves up for a pause. They said they're going to pause. This isn't something we're talking about. They actually said, hey, the pace of is slowing, right? And then they're going to pause and they want to see what damage is this going to cause and will it bring inflation down to their mandate number. And that mandate number is somewhere around 2. Arguably, we think that's too low, but they're not exactly listening to what my opinion is right now, right? But, we think they're going to pause and then they're eventually going to reverse. Again, that's not my opinion if they're going to do that. That's a fact. I think they outright said 2024 might be a period when they really start to lower rates. Now, arguably, if inflation comes down quick enough, fast enough, meaning there's some damage going on. Remember, we said bad news might be good news, and that's exactly what's happening right now, at least from the standpoint of with inflation. We think they start to reverse, let's say in 2023, that's going to set the bond market up. That could set the stock market up to have a much better year, obviously, than what we went through in 2022. Maybe not an incredible great year, but maybe a retracement to half or a good portion of the losses what we saw in 2022. Currency is not as big of an issue right now. We are seeing the dollar decelerate compared to international currencies, which are good. It puts pressure on profits and revenues on companies that are based in the United States that trade goods overseas. So that's good. That's going to affect their earnings less. So that's a good thing. We're seeing recession fears lighten up. They're kind of moving to the camp that we've been in all along, is that we don't see a deep protracted recession. You've never, ever gone in a deep protracted recession when you basically have zero unemployment. And that's basically where we've been at, right? I mean, at one point, we're at 3.5%. I think we moved up to 3.7% unemployment. We're probably going to creep up a bit more because that's what the Fed wants to see so they can continue to feel good about hopefully pausing and then reversing their tightening stance on inflation. But think about this. If we're not in a deep protracted recession, which we are not, you've never gone in one with unemployment rate being so low, you got generally a healthy consumer, you generally have decent earnings. Some sides of the market, like technology, are probably going to be pressured more on their earnings than other sides of the market. So that's why I'm saying we could see rolling recessions in certain sides of the market or industries, but it doesn't have to be a deep protracted recession or even maybe not a recession at all. We'll just see. It could be a light one from a technical standpoint. So everyone's kind of been moving to our train of thought on that. We'll just have to see how it unfolds. COVID shut down in China. Wow, look at that. They've reopened. They did the reopening. Everyone's getting COVID over there, but at least they've reopened. And I think that helps out with the supply chain, helps out with consumption, so on and so forth. So I view that very much as a positive. Inverted yield curve, that's still ominous. That's still out there. It hasn't fully adjusted, at this particular point in the cycle. So we'll just have to see how that continues to unfold. But let's start to break down some of these. The biggest ones that I think that we're looking at least in terms of 2022 and 23, we saw really something very, very, very unique. You saw the worst year ever in US bonds. And I'm going to spend some extra time on that today. So the only time in the past 45 years that stocks and bonds fell together. Now, was it a case that the Federal Reserve maybe caused most of the damage, not just in the stock market, but in the bond market? And my answer to that question I just posed is yeah. I think it was not that the Fed was raising rates, right? Because we all knew they needed to. And they actually needed to do it earlier, probably back in 21. But they didn't. They were a little late to that party. So they had to make up. And it was the pace of rate increase, not the fact that they were raising. Because now we're getting into a more normal stance for mortgage rates, for Fed funds rates. It's really been something that we haven't seen in a long time because money, right? Interest rates that you pay on loans and so on and so forth were so low. At one point, we're almost negative to zero in many bond rates as well as the fund rates. So they had to come off. You got to come up to what? Get inflation down and also have ammunition, right? The Fed needs ammunition to fight whatever fight they need to fight in the future. So they needed to come up, but it was quick. And that forced the stocks and the bond market in tandem to go down. So last year we saw the S&P close down right around 20%, 19.4%. We saw the Dow. The Dow is going to have probably a little more industrial, a little more value-oriented investments, and that's what really outperformed those value dividend plays, a little more boring areas that we liked so much last year. That's what outperformed. Where you saw the Dow at 19.4% drop, you know, about 25, 27% of that is going to be in those more tech-focused areas, consumer discretionary, that get hit so hard because they ramped up so much in that whole tech area to get us through the pandemic. We saw technology being pushed forward 5, 10 years so we could communicate from home. You know, we can order food, order our groceries, and never have to leave our house, right? So that's all coming into check. The valuations are too high. Now we've got to come back down to reality. So that's what affected the S&P. If you look at what's going on with the NASDAQ, look down 33%. Now keep in mind that the NASDAQ has a massive weighting in growth, in tech, or in investments. So if that's what got hit the most, that was the highest valuations. I think it's reasonable to understand why the NASDAQ was down so much, right? So 33% on the NASDAQ, almost 20% on the S&P, almost 9% on the Dow. Pretty huge divergence between all three indices. But if you look over to the right side, I thought this was the most interesting. So the returns on US bonds hit new historic lows in 22. Never have been this low before. Look at this. We have to go back to January of 1842, right? Before we see bonds in general down 22.9%. But we saw the long bond, the US Treasury. And I'm going to break this down for you on what I mean by intermediate total bond and long-term investment grade. But that was down 29%. So if we look at 22, right, we saw intermediate term US bonds, say 10 years less in maturity, saw treasuries. Treasuries, government debt, all right? Basically, US government debt's the safest debt you can own. Why? Because they can tax all the consumers to pay for that debt, right? Like it or not, that's how they do it. Then you might get agencies, municipals were down, everything was down. That's very secure debt, municipal bonds. Why? Because it's of municipalities. Say if you're here in Marietta or Georgia or a project here, they can tax the consumers of Marietta or that metropolitan area to pay for that debt. So look at this. You saw it down 10%, 13%, 29%, 27% for long-term debt out there. Really, from a risk-reward standpoint, you saw the bond market get hit tremendously more than the stock market, right? And I think the pundits in my industry are coming to this saying, hey, listen, from a risk-reward standpoint, stocks still have some things to work through. Some sectors really outperformed, but some really underperformed, like the tech and growth area. The value really outperformed. The staples, the utilities held up. The energy just absolutely incredible last year. So what, from a risk reward standpoint, now you can get paid. Now you can get paid on bonds where you just couldn't before. And let me give you an idea on that. You know, well, I don't want to jump forward. I'll give you an idea of that in a minute. But let's get a little bit more in 2023. So we're calling 2023 basically a show me year. Show me, right? This is our terminology on this. Show me that we're going to go into deep protracted recession or a recession out. Show me that earnings are going to collapse across the board. That's going to justify that. Show me that we're not going to see a buoy in stocks, right? Maybe a reversion to the mean. We've already seen that in the first couple of weeks of 2003. When I say reversion to the mean, what is sold off the most, lowest quality, rallied the most, right? S&P up 4%, NASDAQ up 8%, some stock positions like Amazon, Google, some of these other names up 8, 15%. You know, that's the high growth area. That's the high multiple area. That's usually what bounces back the quickest, and then it'll settle down. And then the ones perform the best will probably underperform. And we did see that the first year. Don't think that's going to continue this year. I think you're going to just need to still focus on high quality investments, even still leaning towards a little more value, but don't be scared to put some good high quality growth in there, because that's not going away. It's just having a little bit of a pause, right? And again, I'm not trying to be, too flippant about the negativity or the negative performance we saw. But in a diversified portfolio, you can't be too much of the one side. You just got to find good quality investments and diversify in that portfolio. But we think really the keys to 2023, kind of looking at 4 different areas. Dividends, that's not going to leave us. Sometimes that follows the value camp. Now, listen, we got to have growth, right? So you can't go into no growth companies. You can't just focus on dividend and high yields, because they might be called what's called an accidental high yield. But what we mean by that is focus on high quality stocks. I prefer companies that are number 1 and 2 in their sector. I like strong cash flow. I like strong management team. I got to have a catalyst for that stock price to move up. If they got strong cash flow, maybe a little more mature, maybe they were a little slightly in that value camp. Maybe they pay some income to reward shareholders to be there, meaning that dividend, right? Which equates to a yield, right? So we want to get paid to wait. If we got to sit and wait for things to kind of work out a bit, I want to get paid to wait and still have the opportunity for a capital appreciation. And that's kind of what you get in that dividend stock area. Again, it's not all value, and it's not all utilities, and it's not all staples. You can have dividend, some of that area, even in the growth patch of the market. So we just need to be mindful of what we mean by that and find that. The other is international stocks. We'll go into bonds, and then we'll wrap it up with don't sit on the sidelines. There's so many opportunities, always a market somewhere. Let's just find it, right? So let's think about dividends. They're such a huge part. You know, we look back in the past, in the 2010s, we saw it made up about 16% of total return. But back in the 70s, in a much more challenging period, at least the late 70s, 80s, which this period with high inflation is compared to or comparable to, we saw it make up 70%. You know, it can be a huge player. Let's say you're sitting on a stock and it's paying you about 3-4%. Just be careful on stocks that pay higher than maybe 6%. Kind of a rule of thumb for us is that what if they cut the dividend? That could hurt the stock price. So we just got to be mindful of cash value, and can they cover that dividend, right, with good cash flow, good earnings. But when we think about it this way, it can help at least soften the pain if the stock doesn't outperform, or that ETF or mutual fund isn't outperforming, but we're getting paid. We're getting paid to wait, right? Not a bad thing. Now let's think about international. And I know international has really underperformed the US, right? Really over the last decade. But that's not always true, right? So remember, we're looking for value. There's a market somewhere. In a diversified portfolio, you're not all in the United States. You might have some international, right? But let's think about it. When the US, and this is this bottom chart right here, when you look at the international markets, I'm going to turn my little drawer on. Let's see if I can have some fun here. Yeah, look at that. So if you look at international markets, when the US returns are -4, -6, look at that. -4%, international markets have outperformed the US 45 of 45 times since 1973 to 2002. Below 6%, 54 of 56. Right? All things being equal, all returning periods, you're still having the U.S. outperform the international markets. Let's see if I can take this off my screen. Well, that's right. Outperform up in the 50 range compared to, the international market's about 41%. So let's think about it. If those stats continue to hold true, those figures, if we continue to underperform, at least performance-wise, and international markets has lagged the United States, doesn't mean they don't have high quality companies. They're just a little bit different in their structure in terms of the makeup. We're very heavy in the high growth technology area, where a lot of international exposure is not. Maybe a little more industrial, maybe a little more financial. So it has a lower PE, might have a little bit lower growth. But if they've underperformed for so long, and if the stats hold true and the US has continued to underperform, why not consider making sure that we have reasonable amount of exposure international? I'm not saying get out of all your US. That's not where we're going. It's a part of a diversification in a portfolio. We just got to see how much and where it makes sense for you. This is the story of bonds, right? And again, I'm not saying dump your stocks and all go into bonds, but if you've been underweight for bonds, you've been looking at opportunity to get paid and lower that volatility, I think that's right in front of us. We saw bonds really the worst ever in history. Never saw bonds and stocks down at the same time together, at least not in the last 45 years. But let's look at that. Look at the low yields here on a U.S. aggregate index, all right? So if you're buying I just want to buy a basket of bonds, you might be looking at the U.S. aggregate index. It was paying about 1% at the low. That's what it was yielding. So that would be the income that it spends off. It adjusted about 3.5%. It's now paying around 4.6, 4.5%. What a massive increase. In the past, think about it, over the last decade, cheap money, for the most part, I'm not saying, all those years, but for the most part, you had to take risk in stocks to get a return, because you couldn't go to your money markets. You couldn't go to the bond market because you really weren't getting paid enough to be over in that area. So what happened? Stocks really outperformed. Fixed income underperformed. Fixed income really underperformed this last 22. But we might be coming back into an era where fixed income looks incredibly interesting compared to, from a risk reward standpoint, than stocks. We think about investment grade corporate debt. Look at that, 5.3% from 1.7. High yield corporate debt, so you're owning debt of companies out there like a Microsoft or an Apple or so on and so forth. Look at emerging market debt. Let's say international debt, 7.6%. Used to only pay you 4%. Tends to be a lot more volatile. Municipal bonds. Wow, municipal bonds. This is double tax free. When you own municipal bonds, again, you're owning debt of municipalities. In say Marietta, where we're located, or Cobb County, or something that they're building from a revenue standpoint, or a general obligation, those make up municipal bond structures. Think about this. If you own municipal bonds in the state you live in, they're double tax free, right? So if we've moved from 0.86 now to 3.55%, look at that. Depending on your tax bracket, that could give you a taxable equivalent, meaning if it was taxable, because right now that's tax free, might be double in the state that you live in. That could give you maybe 5, 6, some situations 8% taxable return. Absolutely incredible. I've been in the business 30 odd years, or close to it, 50 as a company, and some of these numbers I just haven't seen before. Let's go over and let's talk, and I'll wrap it up. Let's just say, don't sit on the sidelines, right? I mean, where is that going to pay off? There's a market somewhere. If you got your ultra safe cash, you need those emergency funds, but why not look at money market funds? Money market funds, we're seeing on our side yielding 4.2%, 4%, 4.4%. That's your ultra safe money in maturities and things that mature in days, not years, not decades. That's your money market accounts, that's your money fund accounts, that's your savings accounts. Now you can get paid. You can get paid in CDs. So there's no reason to sit on the sidelines if you can get paid somewhere and have minimal or no risk. Now you can get paid for that. But let's think, if we just missed 10 of the best days, Look at that. Your return on $1,000 would only be worth $2,040. But if you stayed in, took the ride, if you might, it'd be worth $3,065, right? You missed 50%. Or if you missed 20, you missed 71%, or 30 of the best days, you missed 85%. I mean, that's a massive difference, right? We don't want to miss those returns. We want to keep those, right? So kind of moving on, what we think recessions always happen. They average for about 10 months long. By the time we get confirmation that we're in a recession, right? Because these are economic numbers that are going to lag, that it's going to tell us that come out. We're probably approaching a moment of clarity where we're getting out of that recession, right? So by the time you get confirmation we're in, it's probably too late to make the moves to get out. I really feel that a light recession is probably what we're looking at, not a deep protracted one. The last thing that most people ask us about is, hey, listen, what you hear these terms like hard landing, soft landing. Those seem to be, how is the Fed going to orchestrate, right? The central bank orchestrate this whole tightening policy. So a hard landing, that would mean they over tighten, it pushes yourself into a deep recession. I'm not going to say it's anywhere to the magnitude of 2008. Keep in mind, most of our minds go to 2008 is where we're going to go in a recession. But let me really implore you to really get that out of your mind. 2008 was a collapse of the global financial system. And I really want to stress, they might put a recession label on that, but I call that a massive depression. That is a recession on steroids, right? That's not what we're looking at. Not with reasonably good earnings, not with a strong consumer, not with unemployment rates as low as it is, even though it might creep up. I really think we're going to be more in a soft landing. And I think that's where the market is finally acknowledging. Again, we don't know. We don't have a crystal ball, but we think based on the latter stuff that we mentioned, we think we will. Where you might get a light, mild recession. Inflation is going to ease. We're going to see wage declines. We need that, which means unemployment's going to move up. I know that's not great to hear, but we do need that. That's what the Federal Reserve wants. And then we can kind of muddle through 2020 year, eke out a decent return for this year, and set ourselves up possibly for some better years in 2024, 25, so on and so forth, right? So I guess the moral of the story is embrace the idea of a recession. They come all the time. We talked about it all the time. I know it's no fun to go through, but think about this. We're moving through. Maybe most of the damage that we're seeing right now was done, or expecting right now was done in 22. And then now 23 is just a show me year with less damage, even though we still might get some volatility. Stacy, let's go ahead and open this up to some Q&A.
Okay, sure, Graham. So we did get a few questions in. The first one, for the average investor, how do you know you're in a recession? And I think you touched on that a little bit, but do you want to elaborate?
Yeah, I joke about this, but I refrain to be flippant about it. But listen, if your house drops 20% in value, you get laid off, and your portfolio is down 20%, that's a pretty good clue. You might be in a recession, right? The problem with that is the definition of recession, right? 2 negative gross domestic quarters back to back. Well, that's different. That's not exactly what the Federal Reserve even looks at to say if we're in a recession. So I would encourage to say, quit focusing on the term of recession and just focus on where you're at, because recessions are going to come and go, and we're going to get through it. So I would not solely focus so much on the recession. And by the time we get confirmation we're in it, from the economic reports, like I mentioned before, we've already gone over it in other lunch and learns, we're probably on our way out.
All right.
Yep.
Okay, another question. If the economy does go into a deep recession, what will the Federal Reserve do, and what would my investments do?
Well, stocks are definitely going down, right? Think about it. You might have 20+% drop in earnings, right? Into a negative standpoint, not a positive standpoint, right? So you're going to have the earnings per share, right, of corporations come down, which means in that situation, a more deeper recession, you could see the valuation of the market drift down to about 14 to 15 times forward earnings. We're currently trading at 17, arguably a little high right now compared to long-term trend as we're going into a softer market. That means you probably got another 20% plus drop in the market. from where we're at, maybe a little less. Again, we don't think that's going to happen. We are seeing we're 20% into earnings right now. We're seeing, I think it's, don't quote me 100%, about 75% of who have reported have beat earnings, maybe not as big as they did in the past, but reported earnings. So kind of how I feel about that.
Okay. Now it's time to pull out your crystal ball and tell us
right.
how long will it take? How long will it take for inflation to come back down?
Boy, that is a crystal ball, right? Well, that's what we don't know, right? I'm concerned that maybe the Fed, just to be straightforward, is a little too low in their expectations. I think their mandates, they wanted to get back to 2%. I arguably say for strong growth, GDP or U.S. economy, maybe 3.5% might be a better target, more achievable. So I think we're going to have Fed funds rate higher for longer because they're going to have to crack the wage, which means unemployment's going to have to go up to a degree, maybe up to around 5%, possibly less. And then I think Fed funds rate. So it's all going to be how quick, how fast these companies adjust in terms of their employment, their staff, and start laying off. Whatever layoffs, and I know this isn't what people want to hear, and I hate to put this out there, but the layoffs you've seen, they're going to get worse. But that's actually a positive because that gets us closer to where we need to be. Hopefully that'll crack the wage issue, which is the most sticky part of inflation. And when we crack that nut, I think we're going to really start to see inflation escalate down. So it could stay stubbornly higher this year. We're about 7.2. I think it's going to continue to drift down, down, down. But we could still see higher than average since we averaged inflation over the last decade at 1.9%, so crazy low. I mean, you could see a couple of years of still higher than 2%. But it doesn't, Stacey, let me add one thing. It doesn't mean that the Fed has to or will continue to be aggressive. They will not. They're going to have to stop at some point. They already said they were, which means that can be really good for stocks and bonds. Because if they stop, pause, stocks and bonds went down because of it, things relatively hold up, what do you think bonds are going to do? They could rally, right? You could see stocks really rally. Now, I'm not going to say we're going to hit new highs in the markets overnight. We're going to be a lot higher than where we are now. We'll just have to see.
All right. I think we have time for another one. So growth stocks or value stocks, which is best for this new year?
Whew. If the growth stocks got beat up the most, I think you got to start looking at high quality names, not low quality names. You know, we often say, watch out for a dead cat bounce. Even a dead cat, you throw it off a roof, it's still going to bounce, right? I know that's horrible, right? But it's a term I've heard almost all 30 years. And that's kind of what you're seeing. You're seeing the lowest quality, most beat up rally the most at the beginning of this year. Even some of the high quality, but tech, consumer discretionary bounce up this year. I gave some numbers at the very beginning of the call. But again, there's a lot of damage done. There's a lot of show me on those stocks in terms of earnings. So I'd be cautious. I think you can start having exposure to that area. Just focus on a high quality. Make sure they're making money. They pay a dividend, even better. Follow that mantra that I have out there for you. That's how we look at positions and clients' portfolio from an individual stock standpoint. But I think value probably still has the upper hand for the foreseeable future since it did underperform growth over the last decade. I think it's now taking leadership going forward. And I think that's probably going to edge out growth, but just have a good diversified portfolio. All
right. Well, thank you so much, Graham. This has been great information. And I want to thank all of our viewers for joining us today for getting those questions in. Just want to remind everybody that you can get current market updates from Graham every week on our weekly wrap up, and that's typically on Mondays. So please tune in to those and get the latest and greatest information on what's going on in the market. And then also I want to take the opportunity to let you know that this week we have begun hosting our first retirement planning class of the year. And we do have a couple of spots still open for our Saturday class. So it's not too late to get in there. If you know someone who could really benefit from a comprehensive multi-day class, then they want to prepare to for their retirement, please encourage them to contact us and we can get them in. Also, one more thing, we are excited to announce a new class that we're offering here at our in-office classroom. And you know, as Graham can tell you, we hear some questions multiple times, the same question. And so we decided, why not take this opportunity to educate our clients and their friends or guests on some of these topics. So on Thursday evening, February 16th, our team is hosting a class on investing basics. If you know someone or if you yourself are interested in investing, but you don't know where to start, this is a great opportunity. And you can join Graham and our team, and he'll give you lots of food for thought. This is a special opportunity for our clients and their guests, and we are providing it free of charge. It's especially beneficial to some of the older teens or young adults in your lives that might be interested in getting started investing. So just reach out to us and we'll be happy to provide you with more details. Thanks so much for joining us today, and we will look forward to seeing you again soon. Have a great afternoon.
Thank you.